In the last 4 years, Australian house prices have jumped nearly 40%.
Oh, that's high.
If you'd bought just 12 months ago, you'd have paid around $100,000 less for the exact same house. Every day you wait, the market slips further out of reach. And every dollar of your rent you pay makes your landlord richer and not you. But what if you could stop chasing rising prices and finally catch up? That's exactly why Own Home exists, to help you buy your first home now instead of having to wait years to save a huge deposit. Own Home dramatically cuts down the deposit you'll need. Rather than having to cough up a massive 20% to avoid paying lenders' mortgage insurance, you can secure a $1 million home with as little as $60,000 up front. That's barely more than just the stamp duty costs. They do it through something called a deposit boost loan, backed by CBA's investment arm, so it's pretty legit. The best part, because your main home loan stays at 80% of the property's value, you completely dodge paying tens of thousands of dollars in lenders' mortgage insurance. Sounds too good to be true? Well, there is a catch, but I'm going to break down exactly how it works and how to help you decide if it's right for you. And before we do, if you get any value from this video, give us a little thumbs up. And if you want to get more content like this to help you buy your first home, make sure you hit subscribe. All right, let's dive right in. I'm going to show you exactly how Own Home works using a real world example. With Brisbane's median house price now hitting $1 million, let's use that as our benchmark. Step 1, your upfront contribution. First, you're going to put in the money you've saved. For $1 million house in Queensland, you're going to need around $60,000. This mostly goes to the government stamp duty costs and Own Home's one-off fee. Now, I get $60,000 is still a huge amount of money, but it's a far less than a 20% deposit, like a 200 grand deposit you're going to need. Or with the banks, if you want to get in, the minimum deposit you need is around $130,000. So you're still going to get there a lot quicker using this product. Step 2, the Own Home deposit boost. Next, Own Home steps in and they cover the remainder of your deposit, bringing your total deposit to the full 200 grand. This means your main home loan stays at 80%, which saves you a lot in avoiding lenders' mortgage insurance. Now I'm going to show you how this works in an example in a little bit, so stick with me. Step 3 in the process, your broker will help you get your main home loan. Now you've got the 20% full deposit in place, or it's pretty much a loan from Own Home. But anyway, you'll be able to secure a normal home loan from a mainstream lender. At the moment, these are a little restricted, so it's not every bank that will allow you to do this. There are lenders like Resimac, Homestar, or one of the bigger banks, ING, does allow this. Step 4, your loan repayments. Now this is where this Own Home product is very different. After you've bought the property, you're going to have 2 separate repayments because you've effectively got 2 loans against your house. You can have your main home loan. So this is your standard 30-year mortgage for 80% of the property. So if we bought that $1 million property, you can have an $800,000 home loan from, say, ING. You'll then have a second loan through Own Home as a deposit loan. This is a separate small loan over a 15-year loan term. This will be for the $200,000 deposit that Own Home provided and charged at a lot higher interest rate. At the moment, it's at 13.25%. So it's kind of like a personal loan. Because of this higher interest rate, your goal really needs to be paying off this Own Home loan as quick as possible. Every dollar extra you pay is going to dramatically reduce the total interest costs. Now, there clearly are some trade-offs. The biggest one is the repayments. To illustrate, if you bought the same $1 million home loan with a regular bank, you would be lending $950,000, which includes your lender's mortgage insurance. Now in this case, your repayments are around $6 grand per month because you're paying that loan off over 30 years. With Own Home, your repayments are going to be higher. You're paying the $800,000 home loan off over 30 years, but that separate $200,000 home loan is paid off over 15 years. This means your combined repayments are going to be around $7,200 per month, or around $1,200 per month extra. And this is where there's limitations with Own Home. You're going to need a pretty high income to manage these high repayments comfortably. This is where Hunter Galloway can help. As a mortgage broker, we can compare Own Home versus the current home loan products to see what's going to work for you. If you need help, just hit us up at huntergalloway.com.au. So why would you consider Own Home? Here are some of the biggest wins. Well, firstly, you can enter the market sooner. Like I said in the intro, it gives you the opportunity to lock in today's prices and avoid years of chasing the market. For example, 4 years ago, Brisbane's median house price was around $650,000. If you'd use Own Home to buy then, your property now would be valued at $1 million. That's an impressive gain of $350,000 in equity. Meanwhile, if you'd waited, you obviously need a bigger deposit to get into the market today. The second benefit is lower upfront savings. Instead of needing the minimum, even if you're paying lender's mortgage insurance with the bank, $130,000 in deposit that covers your stamp duty and costs if you're buying through a bank, you can get in with Own Home with just 60 grand. That's crazy. That's $70,000 less. Like think about how many years it's going to take you to save up that extra 70 grand. It could be another 4 or 5 years before you get to that point. Thirdly, you avoid lender's mortgage insurance. Now, Own Home do advertise this, but it's only partly true. You still have to pay a low deposit fee with Own Home. In the example that I showed you before, it's still around 22 grand. So you're still paying that, It's just by a different name. But yeah, if you fundamentally have an issue with mortgage insurance, it's an insurance that protects the bank. Own Home do it a little bit differently. The other big benefit with Own Home is they do give you a free buyer's agency service with it. So even though you're paying that 2% fee to Own Home to potentially get in the market, they do include buyer's agent, and they do coordinate things like the building and pest and negotiate the property price. I've actually seen this work pretty well in action. A couple that recently helped, a nurse and a tradie in Brisbane, had really good incomes but struggled with keeping up the rising market. Within just 3 months, 9 days, it was pretty crazy. Own Home helped them buy a townhouse, which they thought was out of reach. It just helps them get into the market quicker, because at the moment, if you're looking at prices from a year ago, the market's already moved since then, and Own Home with their buyer's agency service can be a really good thing to help out if you're new to the market. Cost and risk. Now, Own Home clearly isn't without the cost and risk, so let's clearly break these down. The biggest risk I see is the higher repayments. The Own Home deposit loan carries a way higher interest rate at 13%. Your best strategy is to aggressively pay this down and get rid of it as soon as possible, because it's basically like a car loan or a personal loan at that interest rate. As I said in that earlier example, the biggest sting is this higher repayments, because you're having to pay off your 20% deposit over 15 years. You're going to pay, in the $1 million example, about $1,200 per month extra. So you need to have pretty strong income to be able to comfortably afford that. The second risk are their upfront fees. Own Home charges a one-off 2.2% fee from your savings. So essentially that's replacing the lender's mortgage insurance. And they say that fee covers their professional team, the buyer's agency, etc. But it's effectively an upfront fee. It's the same thing as lender's mortgage insurance. You don't get it refunded. It's not there to protect you like in the insurance for the banks. It's there to protect the banks. Additional risk. 2 separate loans in this structure are going to lower your borrowing capacity if you're looking at buying an investment in the future. And typically you're going to need an income of above $150,000 to make this work. Equally, there's a bit more risk, because in that $1 million example, if you're only putting down $60,000 as deposit, you are at 100% LVR. So if the market goes backwards, you could risk slipping into negative equity. So for example, you sign up for this loan today, you get $1 million, $80,000 from ING, $200,000 from Own Home. You've got $1 million in that property. And if the market goes backwards and your home's worth $950 in a year's time, that's called negative equity. Now, based on the historic performance of the Australian property market, it's not very likely it's going to happen, but you never know, and it's worth being aware of all the risks before you sign up for anything. But what are your other options? How does Own Home compare to the other options? The government guarantee is amazing, but has pretty strict income criteria and property price limits. Own Home works best if your income or property price exceeds those limits. Versus the bank of mum and dad, a guarantor home loan is definitely cheaper than Own Home. So if you have that option, it's probably going to be worth considering compared to Own Home. The only downside is with a guarantor loan, it does put your parents' property at risk. So be aware of that and have a chat to them to make sure everyone's aware of all the consequences. Own Home versus waiting and savings. Well, savings obviously always the better way to do it. You're going to have more deposit, you're going to have a smaller loan. But the risk is if the market keeps going up, it's pretty hard to keep up with your savings with the rate of property growth. So is Own Home suitable for you? Well, it comes down to 2 pretty simple questions. Number 1, can your budget comfortably handle 2 loan repayments? And at that higher loan repayment, you need to think about that. And 2, what's riskier, taking on Own Home's higher interest rate or potentially missing out on the property market altogether? Now, it's definitely not going to be for anyone. If you want a free consultation to work out if Own Home works for you, or even see what other options are available with government guarantees, with parental guarantees, or whatever else is out there, hit us up at Hunter Galloway. We're a mortgage broker. Our services are free. We don't charge anything. We're paid commission by the banks, and we'd love to help you out. Have a look at our website, huntergalloway.com.au, put in a free inquiry, and we'd love to have a chat and see what's possible for you. We're the home for home buyers across Australia. There's heaps of free resources and things on our website, so check it out, huntergalloway.com.au. Until next time, I'll see you later.